Do you really think that moving to Italy means a paradise of wine, sunsets, while your foreign investments remain untouched? Let me tell you why Italian tax rules may have a bigger bite than you expect. Whether it's about dividends, interest, companies' distributions, enjoying financial freedom abroad also means navigating our tax system. So, what about dividends? Sharing profits, sharing taxes, how those dividends are taxed in Italy. Foreign dividends are taxed as part of your worldwide income. And here's how it works. Gross income inclusion. So all dividends, whether from stocks, private companies, are added to your taxable income. And then the current flat rate on this gross amount on dividends is 26%. And then before paying taxes, there are the tax treaties kicking in. If your dividends can bring from a country with a tax treaty with Italy, you might qualify for a reduced withholding tax rate to avoid a dual taxation through the foreign tax credit. And generally speaking, they put a cap. So let's take a real life example. Marco, an Italian tax resident, earns $10,000 in dividends from a US-based portfolio. The US applies a 15% withholding tax. So under its treaty with Italy, he can deduct $1,500. What is the Italian tax liability? Based on the 26% rate of the 10,000, the gross liability would be 2,600. But of course, he can claim a tax credit of 1,500 for the US. So the difference that he owns is 1,100. And remember, some countries withhold way more than the 26% rate, way more than 15% tax rate. So take care and make sure that the dual taxation treaty allows such a credit use in Italy or in the other country. And dividends from countries without a tax treaty might face a dual taxation, paying twice as much. What about interest? How interests are taxed in Italy? And once again, Italy applies a flat percentage of 26% on foreign investment income. Interest from bank accounts, bonds, financial instruments are included in this category. So let's say Sara, a UK girl living in Italy, and she earns 5,000 interest from, UK treasury bonds. The UK withholds 10% under the tax treaty with Italy, so 10% of the 5,000 is 500. The Italian tax liability is 26% of the 5,000, so actually 1,300. Minus the 500 credit from the UK, she owns just 800. And once again, remember, failing to report foreign interest income could lead to penalties and back taxes, worldwide income taxation. What about company distributions? Well, distributions from foreign companies, especially if you're shareholders, can really be complex to tax because regular dividends are taxed at 26% like other dividends, qualified or general. But capital distribution, if part of the distribution is considered a return of capital, it may be exempt. And then the CFC, the Controlled Foreign Company rules kick in. If you own a significant percentage of the company as ownership, Italy might tax return earnings even if they're not distributed anyway. So let's say John, an Italian resident, and he owns 50% of a US LLC and received 20,000 distributions. US withholding tax first. The LLC applies 15% withholding tax, around 300 under the US and Italy tax treaty. And then we have the Italian tax liability. So John owns 26% of these 20,000, so around 5,200. So the total net tax due is 5,200 minus the 3,000 already paid, 2,200. But if we're talking about the CFC, Controlled Foreign Company, if the LLC returns 50,000 in profits and John, for whatever reason, is deemed to have the control of this company, Italy applies the CFC rules against him, so he might tax his share of return earnings at the marginal rate. It could be as high as 43%. So how you can avoid the dual taxation? Foreign tax credit. Italy signed several hundreds of tax treaties that often include provisions for foreign tax credit allow you to offset taxes paid abroad against the Italian liabilities. If you earn 15,000 dividends from another company, if they apply a 35% withholding tax and Italy requires 26%, you have to take a look about what's the maximum cap allowed to offset foreign tax credit paid, more than 15% or whatever. Always check whether or not your foreign income qualifies for credits in Italy under the Italian tax treaties to avoid overpaying taxes. There is something you cannot ignore: reporting obligation. Expats must, remember this word, declare all foreign income on the annual Italian tax return. And additionally, for foreign assets like stocks, bank accounts, you have to go with the RW form, a specific page or framework if you want of the Italian tax return. And failing to comply could lead in health penalties ranging from 3,000 to 15,000 per undisclosed asset. Let's say you're an expat from France and you fail to report a 100,000 stock portfolio for whatever reason because you assume that you already pay taxes in your own country. When audited, I'm not saying if audited, I'm saying when audited, you may face 10,000 in fines and back taxes for this mistake. Key lesson: always plan ahead. The Italian tax system can seem, very annoying, very frustrating, daunting if you want. But with the right strategies, you can actually minimize your liabilities and stay compliant at the same time. There are some tips that are evergreen to my taste. Diversify income streams, explore sources with favorable tax treaties, and choose countries that sign a tax treaty with Italy. Plan distributions carefully. Remember the cash basis principle. So avoid triggering unnecessary, for example, control-based company taxes. And the last one, the obvious: work with experts, real experts. An international tax advisor can identify opportunities to optimize your fiscal position. And remember, the ultimate goal is to pay less in every country, not just Italy only. Remember, the golden rule here is to invite everyone to your table, not just yourself or your goals, but also your country where you come from, Italy, and find the best solution for everyone that makes fiscal and financial sense for everyone.